Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Tesla has been crashing for the last 2 weeks due to the unfortunate and sad events in Ukraine and Russia. I don't want to speculate on how these events may unfold. There are people more credible than me on that. I just want to hope for the best, and my thoughts are with the people in Ukraine. Over the last 2 weeks, we've seen the stock drop from the mid-900s after it had already taken a beating from the Fed. Then the stock dropped all the way down, even dipping into the 600s. Over 40% drop from its all-time high as early as back as January. But the questions we really want to know is, could the stock dip any further? How long might it remain down? And when might we see the stock jump back? Let's begin with the first question of how low might it go? There are some people throwing out numbers of around $500. We always hear stupid numbers, but if Tesla has dropped below half from its all-time high in the past, and it wasn't that far off this time either. However, back when it last dropped like this, there was no real yardstick. Tesla were not making any profit. The market wasn't sure Tesla were capable of achieving the unachievable. Tesla hadn't even proven themselves on manufacturing, let alone demand or making a profit. Now we have the PE ratio as a yardstick. And if Q1 is going to be perhaps $3.5 billion in earnings, if we annualize that, we're at $14 billion in earnings. Tesla's stock price is sitting at $830 right now. Tesla currently has a market cap of around $830 billion at the time of this video. Just to point out, 830 divided by 14 is 59, implied almost a PE ratio of about 59 relative to Tesla's upcoming Q1 earnings report. How low might Tesla stock go? Well, let's say the stock dropped to $500. Let's use the same math, divide it by 14, and we get 36. Hello, if Tesla dropped to $500, we have a PE ratio of 36. And this doesn't even factor in depreciation or amortization and a lot of other growth areas. But even a PE ratio of 60 for Tesla in this day and age is unexpected. And then what about Q4 in 2022? I estimate to be about $5.5 billion in earnings, becoming $22 billion annualized. Well, at the current stock price, this would end up becoming a PE ratio of 830 divided by 22, which would be a PE ratio of 37. I'm not saying the stock won't be absolutely crazy, and obviously it all depends on yet another major macro issue. Right now, the market and global economies are really trying to shake out all the paper hands. Maybe it's a plot to shake out as many weak investors out of the market before it shoots up to record highs. But when the market loses perspective, make sure you maintain yours. It is ridiculous to have Tesla sitting around these future PE levels. Tesla have a long way to go. I bought on this dip when the stock price was about $780. I bought a Leaps that had an expiry of January 2024 and expiration date of $900 for a price of $200 a share. I sold 30 shares to do this. When others are fearful, be greedy. This is 2 years out, and although I haven't done my forecasts yet, I have some idea. But in reality, it's allowing Tesla enough time to ramp up to volume production for 4680s. I'm hoping by the time 2024 has come along, Tesla have reached a good run rate. It could be between 100 gigawatt hours and 250. Either way, even 100 gigawatt hours is enough for 1.5 million more cars, i.e. from Texas, implying that if the other factories combined even did only 2 million, then that should be 3.5 million vehicle run rate by 2024. Even at 3 million though, we've broken past all sorts of barriers of economies of scale, thus reducing costs, whilst also improving manufacturing techniques, resulting in improved gross margins, resulting in stellar profit. What Tesla is trying to achieve is close to impossible. Clearly, if it's this hard for Tesla, no one is coming close for some time. Hence, why just in case, I'm allowing Tesla 2 years to really prove themselves. Over that time, all sorts of things could have happened in the company. We should have seen some FSD advances, for example. Anyway, we all understand this is a long-term thing. My point is perspective when Tesla drops. I can't see Tesla trading sideways for 10 years or something, like what happened to Microsoft after the dot-com bubble. It actually took something like 17 years for Microsoft to recover from the dot-com boom. Yet if you bought the stock at the peak of the bubble, you would still be up 5 times your money today. But that was a long, boring, difficult hodl. Even in a recession, it will take a lot to hold back Tesla's demand. The EV industry is growing rapidly, and AVs will grow at an even faster rate again. If Tesla can 10x earnings within a couple of years, then the stock price will take some notice of that. We might be in for a bit of a wait again though until these earnings put some serious wind in the sails, particularly with these new factories likely to affect earnings. Visualize this for a second. Picture yourself in the future 1 year from now checking the stock price and Tesla showing a PE ratio of 35 or even 50 It doesn't look right, does it? Assuming Tesla hit these production estimates and profits. It's investing, so nothing is guaranteed, but Tesla's Q1 ends in weeks now. This should lock in some good profits, offering a better base for Tesla's stock price. Who knows, if Tesla don't release FSD soon, perhaps the market will crucify Tesla as a robotics and AI company and say it's solely a car company. Of course, even if it's just a car company, it's an EV company, which mature should still warrant a PE much higher than an internal combustion car company. Somewhere between 20 and 30 would be my guess, especially given all the future technology improvements and cost reductions to come. The point is, even if that was the PE ratio Tesla was given, Tesla's earnings could still grow out of that in 2 years. Tesla failing in FSD takes Tesla out of the AV industry, which has a very high PE ratio, and places Tesla into the EV industry, although Tesla is more of a smart vehicle than just electric. Either way, it won't be in the ICE industry. Remember, these ICE PE ratios are also struggling due to having to give up so much more profit from unions and car dealers, among other things. The EV industry can sport a higher PE ratio for these reasons also. Historically, Tesla's stock has dropped half from its all-time high before, which would now take the stock to low 600s. At this price, all our heads will be spinning. I mean, hopefully it's this low due to mass hysteria of the market and not some catastrophic event. I mean, if it's down that low for that reason, although the buying opportunity looks tremendous, that is probably a bit more red than pains me to see. I'm content with my Tesla holdings currently. I'm ready to move on now and see the stock green again, and will save more buying for the next dip. Anyway, markets are mad, and there's some serious macro threats, so it could drop to anything, but I think the support of Q1 might hold up for the time being. After that, hopefully the new factories, but after that, if the macro environment is not stable, then it's anyone's guess. However, if it is stable enough, then I think we could see the stock flat for most of the year, along with some dips, especially if we run into some issues with the new factories and production lines. Plenty of potential potholes there that could tank the stock, offering more buying opportunities, unless we are being heavily sandbagged and Tesla will produce an absolutely insane amount of 4680 batteries from Texas in the near future. Therefore, I can't see the stock remaining down anything like $700 by Q4. There is enough reason, and possibly combined with FUD and market manipulation, for the stock to remain sub 1000 for a good part of the year. Again, Q4 should hopefully be the savior here, but that will very much come down to the 4680 ramping, i.e. 4680s are the savior and the main thing to keep an eye on, just like I've been saying all last year. Of course, don't get distracted and ignore what's going on in China at the same time. You could look at China as a different operation altogether. The US, and eventually Berlin, will be using a lot of 4680 batteries, and the advances in production will depend on 4680 progress, whereas China is a different kettle of fish. It will depend on CATL's LFP ramping. Tesla's Shanghai operations will grow as fast as CATL can ramp up their batteries. Then, once the chips are once again abundant, quite possibly in Q4, then Tesla can go full blast. Now, this I would think would be a big enough boost to move the stock. I mean, at this time of the year, my price target is $1,500, but I know some of you right now would be happy enough just to see it back at $1,200. I know how some of you feel. I've been there before, and I'm there now, of course. But this is Tesla. A lot of Tesla investors have made a lot of money by holding through these sufferings and buying on these dips. Sure, it gets easier each time in some ways as you get used to it, and because you are likely up more each time too. Of course, the loss is higher the more you accumulate, as you have more to lose. But that's Tesla. No one said it was going to be easy. Just invest in Tesla here, and you simply put as much money in as you can, and then ride in the escalator as the stock price increases each day until it's up 10 times. Simple and easy, and then you're a millionaire. No, it will test you and hurt you and make you pay. Just remember how early days we're still in, and how relatively young Tesla still is. Tesla is a serious workout for investors. If you can handle Tesla, then any other stocks should be a walk in the park. Despite how hard it may be to hodl Tesla, the rewards are more than worth it. As long as Tesla's demand holds up, then eventually the stock price will catch up. Tesla has been overly punished too, especially compared to the rest of the market. The market clearly doesn't understand it yet. To summarize our original questions, if the stock drops as low as sub 600, then putting it into perspective to Q1 and future earnings, it seems very low. But it would all depend on what took us to that level. Then I'm suggesting it may take until Q4 earnings to put the stock straight again, after it possibly being flat for a large part of the year. And the stock price trading range during this flat period will be dependent on macros. Let me know all your thoughts in the comments below about what you think is happening with the stock. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.